Nigeria's economy retained its position as the fourth largest African economy after outcomes of a rebasing exercise showed the economy expanded to 372.8 trillion naira, that's $243 billion in 2024 from 314.02 trillion in the prior year, as more sectors in the informal economy were considered in its calculations, and the base year was revised to 2019 from 2010 previously. The Nigeria Central Bank Monetary Policy Committee also decided to hold monetary parameters unchanged yesterday. Hello and welcome to Global Business Insights. Today we focus on the rebasing of Nigeria's gross domestic product and the concluded Central Bank of Nigeria Monetary Policy Committee meeting. This is Bode Oshosami. Nigeria's gross domestic product grew by 3.13% year-on-year in real terms in Q1 of 2025, according to the National Bureau of Statistics. This was higher than the 2.27% recorded in Q1 2024, but lower than 3.48%, 3.86%, and 3.76% in Q2, Q3, and Q4 2024 respectively. The performance of the GDP in Q1 2025 was driven mainly by the services sector, which recorded growth of 4.33% and contributed 57.5% to GDP, as the industrial sector continues to have a declining share in economic activity. Nigeria's debt to GDP ratio also dropped to 39.4% in Q1 2025 following the rebasing below the government's 40% target. The more interest rate sensitive industry sector saw a decline in the mix as services, which is about banking, telecoms and finance, takes a larger share, given that industrial jobs tend to be more stable, formal and export-oriented, and supports more extensive, wider value chains from suppliers to transporters. It could also imply fewer jobs added. However, reversing the trend will require more stable electric power, lower cost of funds, and other targeted support. Also note that the latest growth data for Q1 2025 is essentially outdated. For a feel for the current economic growth, the S&P Stanbic IBTC PMIs for April, May and June are already available. In June, we saw PMI down from 52.7 to 51.6. So you can see the momentum slowing somewhat, barely still above expansion. Based on the PMIs in the second quarter, Q2 GDP growth remains below potential and not likely to be much better than Q1. In other words, far from the at least 5% GDP growth needed to achieve government target of $1 trillion economy by 2030, with the renewed focus on domestic investment and local production under the Nigeria First policy. The latest data from Stanbic IBTC S&P expects the Nigerian economy to grow by 3.5% year-on-year in real terms in 2025, but post-GDP rebasing may amplify this growth to 4.2% year-on-year, according to Stanbic IBTC researchers. Now the rebasing has been done with an, if you like, underwhelming increase. It seems 2025 growth is likely to remain under 4%, given the momentum we saw in the PMI data and the latest rebased print. Also, according to the latest Business Expectations Survey report of the Central Bank of Nigeria, all sectors reported a positive outlook for employment and expansion in June, but identified significant operational challenges include high interest rates, insecurity, and insufficient power supply, which could potentially moderate future growth. On inflation expectations, the latest CBN survey shows that 71% of respondents perceived high inflation in June compared to 75.3% in May. The Central Bank of Nigeria Monetary Policy Committee met and held monetary parameters unchanged.
The committee decided to maintain the current monetary policy stance and hold all policy parameters constant as follows. 1. Retain the monetary policy rate, MPR, at 27.50%. 2. Maintain the asymmetric corridor around the MPR at plus 500 to minus 100 basis points. 3. Retain the cash reserve ratio, CRR, for deposit money banks at 50% and for merchant banks at 16%. And 4, keep the liquidity ratio unchanged at 30%. The decision was premised on the need to sustain the momentum of disinflation and sufficiently contain price pressures. Considerations. The committee acknowledged the decline in headline inflation in June 2025, the third consecutive month of deceleration. This was largely driven by the moderation in energy prices and stability in the foreign exchange market. Despite these positive developments, members observed the uptick in month-on-month headline inflation, suggesting the persistence of underlying price pressures. The continued global uncertainties associated with the tariff wars and geopolitical tensions could further exacerbate supply chain disruption and exert pressure on the prices of imported items. Members also noted the continued stability in the banking system, evidenced by the stable financial soundness indicators, FSIs, which would further be supported by the ongoing banking recapitalization exercise. The MPC noted that 8 banks have fully met the recapitalization requirements, while others are making progress towards meeting the deadline. The committee thus urged the management of the bank to sustain its oversight of the banking system to ensure continued resilience, safety, and soundness of the financial system. Price and other developments. Headline inflation year-on-year declined to 22.22% in June 2025 from 22.97% in May, primarily driven by the moderation in energy prices, especially cooking gas, wood, charcoal, and diesel. Food inflation year-on-year, however, rose to 21.97% in June 2025 from 21.14% in May, attributed mainly to the increase in the cost of processed food. Core inflation, that is, all items less farm produce and energy, also increased to 22.76% in June 2025 from 22.28% in May, reflecting an uptick in the cost of information and communication, housing and utilities, and personal care and social services. On a month-on-month basis, headline inflation rose to 1.68% from 1.53%, largely due to increases in the price of services and imported food. The committee acknowledged the efforts of the federal government in improving security and its impact on food production. Members thus urged the government to continue its support towards timely provision of high-yielding seedlings, fertilizers, and other critical inputs for the current farming season. The MPC also noted the sustained stability in the foreign exchange market, accentuated by improved capital flows, earnings from increased crude oil production, rising non-oil exports, and significant reduction in aggregate imports. Real GDP in the first quarter of 2025 grew by 3.13% compared with 2.27 and 3.38% in the corresponding and preceding quarters of 2024, respectively. The external sector also remains stable and resilient, despite persistent.
The speech was more hawkish than expected, at best a tone of cautious optimism with little signaling on future rate actions or even guidance on macroeconomic indicators, as the governor retouted achievements in macroeconomic stabilization. All this as it aims towards single-digit inflation, saying nothing on the government's trillion-dollar economy by 2030 goal. For now, it continues to be a wait-and-see approach as reforms are embedded and the Central Bank of Nigeria remains very much data-dependent. More business news. Yesterday, Coca-Cola reported quarterly earnings and revenue topping analysts' expectations. Earnings per share came in 87 cents versus 83 cents expected on $12.62 billion revenue. Coca-Cola saw stronger demand in Europe, offsetting weaknesses elsewhere. Coca-Cola is guiding that 2025 earnings per share growth will be about 3%, also the upper end of the range previously provided. The company restated its forecast that organic revenue will increase 5 to 6% in 2025. AstraZeneca plans to invest $50 billion in bolstering its U.S. manufacturing and research capabilities by 2030, becoming the latest pharmaceutical firm to ramp up its U.S. spending after U.S. trade tariffs. General Motors Q2 earnings took a $1.1 billion hit from tariffs, but the automaker still beat analyst expectations for the period, helped by strong sales of its core gasoline trucks and SUVs. Scott Bessent, U.S. Treasury Secretary, has called for an inquiry into the entire Federal Reserve institution. He said the Fed's independence is a cornerstone of American stability, but that its autonomy is threatened by mandate creep into areas beyond its core mission, but also adding that he sees no reason for Powell to step down for now. U.S. stocks continue to rally, but many are questioning the breadth of the rally as more earnings are announced. All this as investors embrace a more cautious outlook given the reliance on performance of a few tech outperformers. Asia Pacific markets were mixed after U.S. President Trump said the U.S. had reached a trade deal with Japan, which sets a 15% tariff on imported goods. Toyota shares soared 10% on the news of the agreement. That's all we have time to take in this episode of Global Business Insight. Bye-bye.